Good evening, friends. Today, in this series on stock market investment strategies and techniques, we'll talk about value investing and growth investing. Of course, I have covered this in a small way earlier also, but I wish to tell you that this one concept of value investing versus growth investing has been the cornerstone of the glorious success of many a famous stock market investor, from Warren Buffett to our own Rakesh Jhunjhunwala and many others in India and abroad. If you want to succeed in stock market and make money to your satisfaction, definitely this one concept is very essential for you. So kindly give adequate attention to this concept of value investing versus growth investing. Value stocks are those stocks in which the intrinsic worth of the stock, the intrinsic value of the stock, is higher than its current market price. There are metrics to find the intrinsic value of a stock and compare it with the current price. Current price is a market price which is ruling currently, but the intrinsic value or intrinsic worth of the stock has to be found by applying several metrics and several subjective criteria also. One simple criterion is the book value. Suppose the book value of the stock at present is much higher than the current market price of the share. Then we can say the stock is underpriced. Generally speaking, price should be equal to or higher than the book value. The price earning ratio, will deal with price earning ratio etc. in detail in a subsequent video. But for the present, understand that the price earning ratio, if it is lower for the company compared to the average price earning ratio of the sector as a whole, then we can say the company's stock or share is underpriced. Likewise, the price to book value, price earning ratio is a sure shot guide in many cases, but in some cases price to book ratio is a indicator of the fact that the company's share may be underpriced. The average price to book value ratio of the company versus the average price to book value ratio of the entire sector, when you compare them, if the company's price to book is less, then it is underpriced. So there is an intrinsic worth in that. Now sometimes the company's stock may become underpriced for certain reasons, like the CEO may be embroiled in a controversy, the company may be involved in a scandal, or there may be some rumors about the company violating certain tax laws or something like that. For example, in the recent past, Vakrangi Limited, which was ruling at around 600 rupees, fell down to around 130 also. due to certain rumors. Whether the rumors are correct or not is one thing, it is for the investor to judge. Suppose an investor feels that all the rumors, all the scandals are fictitious, are made up against the company, then maybe he finds value in it and he may go for it. So, value investing basically means at the present moment. You need not go to the distant past. At this point of time, the market price of the company is far lower compared to the intrinsic value or worth of the price of the company. So it is worth buying and wait until the market discovers its value. By applying the metrics like book value, price to book value, price to earning ratio, it is easy to find the value stock and invest in it. When yes investor Rakesh Jhunjhunwala invested in Titan, probably it was a value stock. Now we will also see growth investing, so that you will have a fair value of what is value investing, what is growth investing. Value investing basically relates to the present, whereas growth investing relates to the future. The company is expanding its operations significantly. It is charting out new strategies to sell in new markets. It is trying to use its capacities much better, or it may be trying to manufacture new products, or it may be trying to go into import substitution products, or it may go for backward integration or forward integration. There are many such circumstances in which a company tries to sell more of its products or more products, more of the existing products or more products. It often happens in the case of many companies, especially in pharma companies. They are always trying to manufacture new products. So that is also a growth story. If the products succeed in the market very well, then the company's sales and profits will reflect a much better picture than the present. Now, sometimes the company's growth strategies take a long time. In some cases, the companies try to invest in growth in small chunks of time. Say, every 3 months, every 6 months, they try to commission new capacities. In which case, the growth comes in small chunks. And the fruits of the growth are visible periodically, taking the company's share price upwards almost every quarter. In some cases, the growth may happen over a long period of time, like 1 year, 2 years, 3 years also. In case of steel plant, sometimes it takes 3 years. In case of electricity generation plant also, it may take about 2 to 3 years. In which case, the average investor may have to wait to reap the fruits of that growth for a long time. It may not be possible for a small investor. So you will have to keep the duration of the growth, and when the fruits of growth will become available to you. Again, while value investing gives you immediate value, or probably the share price will not fall down at all, in respect of growth stocks, because the growth happens in the future, there is always some uncertainty about the future. The growth may come a little late. In other words, the projects may get delayed, or the project cost may increase, which reduces the profitability of the products. Or the products which come out of the expansion may not measure up to the quality envisaged earlier. Or the products may not meet with market acceptance. Or sometimes when you make your new expansion, somebody else may also start the expansion, and the product market may get saturated. So there will be a tussle for meeting the demand by different players. So that also happens sometimes. So growth investing is a sort of aggressive investing, whereas value investing is a sort of defensive investing. Whenever you look for buying the shares of a company, you will have to judge for yourself whether it is a value stock or a growth stock, or presently a value stock, but it is also a growth stock in the future. In other words, we call it as a hybrid stock, value plus growth. So you will have to judge all these things before you invest in it. Do not ever invest in stocks without applying some of these criteria. Some more criteria that you can look at is return on equity. What is the return on equity in this company? What is the return on equity in similar companies? This also is a point that you have to look for. If the return on equity here is presently less but likely to increase in future because the average return on equity is more in the sector, then it's a value stock. Now, look at the way quarterly results of the last 5-10 quarters. If the earnings per share has been increasing, but the price has not increased, it's likely to be a value stock and you can profit from that. Some companies give their own projection or guidance for future earnings. If that is very bright, that also makes it either a value stock or a growth stock. So like this, you can make fundamental analysis, technical analysis, market research, value research, product research, etc. to determine whether the company's share is a value share or a growth share. Whether you are investing in a value stock or a growth stock. Based on that, your investing style will be value investing style or growth investing style. Now, if you apply these criteria very well, you will not usually fail in your investment. This is how Warren Buffett has made the art of investing actually as an art and also reasonably reliable science. Please, whenever you invest, apply these criteria, find out whether you are doing value investing or growth investing, and then do it. Wait for the relevant period and succeed. I wish you all the success. Master this value and growth investing styles and become a winner in the stock market. Thank you.